Amy, Chris, Mark, thank you so much for joining us. Great to see everybody here. I guess I wanted to start off with, here I sit in my attic slash workout room, taking me a little while to figure out how to do what I do. And I guess I'm curious what your experiences have been on the investing side. How do you find a deal when you're stuck in your attic, your bedroom, your kitchen? How's that experience been, Amy?
Yeah, it's definitely been very different. We're based in California, and we have been remote since March. I think 13th was the day that we stopped going into the office. So it's been interesting. We've just spent a lot of time on Zoom, as has everybody, and having a lot of conversations with startups remotely. It's definitely a different thing for us because we like to really meet our startups, in person and really get to know them a little bit better. But unfortunately, that's just not possible here in California. So lots of video meetings with our various startups, and really the more interesting thing is deal flow. We attend a lot of events for startup competitions and demo days and things like that, and that has been very tricky, obviously, during this time. And so we've spent a lot of time on virtual events, but it's just not quite the same. Some things I think might be a little bit better, though. The presentations are usually pre-recorded and maybe a little cleaner, but I don't know if that's good either. So that's kind of been what we've been doing.
Yeah. Chris, your experience, are you playing defense more, or are you on offense here?
Well, it's still very much on offense, but it's a combination. I mean, early days, look, in the March, April, May timeframe, there was a lot of focus on just shoring up the balance sheet of our portfolio companies. I think the mandate then was get in a position to ride deep into 2021, job one. No one wanted to be out there fundraising because they had to during the heat of the storm. But at the same time, entrepreneurs have done a very good job of networking to investors over the last several years through all kinds of digital channels and introductions and relationships. And frankly, I have, even pre-COVID, have taken so many introductory pitches over Zoom or some other channel that this isn't necessarily new. The one thing that's new is it's a heck of a lot easier to schedule because I'm not spending any time on an airplane. In 2019, I flew more than 450,000 miles. Not so much this year. So it's pretty easy to schedule things. So it's actually been a robust time.
Yeah, interesting. Mark, your experience.
Well, I've been remote since the beginning of the year as well, or since late February, March. And I think I've found that that really hasn't been detrimental to productivity. I think as I step back, we just held an investor conference the last 2 days. We do it annually. We did it all remotely. And one of the things that's increasingly becoming clear is that there's a lot of derivatives, there are a lot of implications, but maybe the single biggest implication from the COVID crisis has been what we've each experienced, which is that we can be just as productive without all the business travel. I think it's hard not to reach the conclusion that there's now there's going to be a structural decline in demand for corporate travel, for business travel, for those meetings. Companies aren't going to be sending as many people to wind up Salesforce deals. They're not going to be sending as many people to those accounts. Maybe one person goes and everybody else zooms in. I think there's just going to be a dramatic change. That's remote work has led to dramatic change, dramatic reduction, structural reduction in the need for business travel, corporate travel. And to me, I'm experiencing that in person, and I think that's a broad implication across the industry.
I'll jump in on that while we have a frozen video. It's interesting because this is a debate, we're having across the. Whoops. Sorry, Jake, but I just would love to address this issue.
Hopefully we can.
Sorry. But I was going to say my perspective is that yes, for travel to meet with colleagues in your same company, I think that's going to go way down and people are going to Zoom. But when it comes to engaging with partners, sales targets, and other types of relationships, as soon as the Morgan Stanley salesperson lands a book that all of the other competitors didn't land because he or she made a trip to New York to meet with the company face to face, everybody's back on the road. And I do think that in the end of the day, spending time with people face to face is a huge difference in terms of what you get out of it. I know that's definitely the case for us as investors. And I just think that, when the engine starts turning again, competitive and ambitious people are going to be out on the road, and then they're going to drag everybody else off the couch because we're just going to have to be there to compete. That's my thesis. And that could be, late 2021, but I do think corporate travel is going to make some comeback.
Yeah. So, and we can drill down more into kind of the impact on the industry and things like that. One of the areas I did want to get into, since we're a panel of financial folks, and there seems to be a whole lot going on in terms of capital flow, I wanted to talk a little bit about IPOs and capital flows in general. We've had a wave of pretty high profile IPOs hitting here, Opendoor, DoorDash, Airbnb. And I guess it's the latter that's really kind of catching my attention. Mark, from your end, I'm curious your thoughts. I understand why a travel company probably wants to raise a little money right now. A little less clear to me, though, why there might be demand amongst investors for something like that. What's your thought?
Well, I don't have a formal opinion on Airbnb, but what you're saying, talking about with the IPO market is absolutely right. There are a lot of deals coming out. I don't have an opinion on any single one of those for regulatory reasons, but I think people are coming out. You've got markets at close to all-time highs. Look, we recovered pretty quickly. I mean, we had a dramatic snap down in the market in March, April, and then we took about 3 or 4 or 5 months, but we've come all the way back. And companies that want to go public, this is close to an ideal time to do that. You want to go when equity markets are relatively robust, and investors, over the years have become increasingly interested. We're coming back to growth. I think it's been a long time coming, and we've had good growth IPOs the last couple of years. But the couple of those names you mentioned, they fall into the category of, I want to find growth assets, companies that can grow, after COVID or even with COVID, 20, 30, 40%. And there's a few of those names that you mentioned that are able to show that. Some of them actually have been COVID winners. So it's that's why you're seeing a lot of high profile IPOs. And I think that you're going to see that into the first quarter of next year too. I think that's a good thing for public markets, good thing for public investors. You're going to have more options. And I think it's a smart decision on a lot of these companies. Go public now. There's a thirst for growth, and multiples are reasonably robust.
Yeah, and I guess I'm curious. So, we're talking about a couple of specific IPOs there, but one of the other things we're seeing is a traditional IPO isn't the only route to go anymore. We've seen things like direct listings, and one of the more recent things has been a wave of SPAC deals. And I guess for, Chris, I want to turn to you here. Your firm actually filed for a SPAC deal. Can you give me a sense of what the heck a SPAC is, why people are doing it, and what your SPAC is all about?
Sure. So, SPACs are what many people are referring to as blank check corporations. So it's essentially a vehicle that's created, that's publicly traded. It's a trust of cash, and the managers of the SPAC go out and find a target company. Once they find that target company, as part of the transaction is the target company inherits the balance sheet of the blank check company and becomes, through a de-SPAC process, a public company. So in short, it's a sort of a on-ramp to becoming public that's an alternative to some of the other things that you mentioned, including an IPO. What's different about it is it tends to be much faster. Companies can go from first discussion to public in 90 days working with a SPAC, and it's much less exposed to at least the transactional risk of getting public, because it doesn't have that same sort of opaque, strange pricing that happens in a traditional IPO, and market conditions aren't as critical to whether the transaction is successful or not. So a lot of companies, I think, that are looking for an alternative on-ramp to the public markets are using SPACs. And, SPACs, being a public company, can be a terrific financing strategy, especially coming out of COVID, where we're going to be seeing, travel macroeconomics, growing 10, 15, 20% compounded annual growth for the next several years as we come back. And this sort of renewed interest and energy in using technology to drive agility and productivity into business models. We think there are going to be more and more interesting high growth opportunities for private companies. And those that want to get on the offense would find, being a public vehicle, being a public company is a very, very, very favorable financing strategy.
And you also have a SPAC of your own. What are you looking for?
That's why I'm pitching it so strongly. But yes.
So what kind of deals are you looking for? Certain areas in the travel ecosystem? Which direction?
Yeah, so we're pretty opportunistic, except for that we're very sector focused in travel and transportation. We have historically been, B2B investors, but we've also had some very successful consumer side investments. I think, we're definitely looking for growth stories. And again, I think for us, we're not interested in sort of catching the falling knife, as it were, looking for those companies that have been heavily impaired by COVID and just riding them through the recovery of travel. We're looking for those companies that see an opportunity to get on the offense, that, really see the macroeconomic environment and the view ahead over the next several years as an opportunity to grow share and build a great long-term growth company. So, we're looking for those types of management teams, those types of tech stories and so forth. And we think there's a lot of great targets out there around the world.
Yeah. Amy, I want to turn to you in terms of capital flow. With the lockdowns, with the pandemics, are you seeing any stifling of activity? Startup activity still robust, or has that really cooled off?
Yeah, I think it's still pretty robust. I'll talk about it from two different perspectives. Obviously, from a corporate venture capital firm perspective, which we are, it's been a different year for us in that we've taken a little bit of a pause to think about what is the right opportunities for us to invest in, or, when might be the right timing for that. I think 2021 will be a different year for that from that perspective. The startups that we're seeing are really interesting. We've looked for a lot of really interesting new startups that we could potentially.
Can I interject with a question?
Potentially invest in, but
thanks.
Also are trying to protect our portfolio and make sure that our existing companies are also doing well and continuing to prosper during this time. We invest in a lot of early stage startups, so it's a tricky time for them. Some have recently done fundraising and are totally doing fine. Others are struggling during this time, and so we're working with them on how to think about cutting cash flow out the door and making sure that they are in it for the long haul. And then what can we do to help them, especially going into 2021. So hopefully that has answered the question.
Yeah, and I think we had a question coming in from Truda.
Yeah, I just want to follow up, Chris, on what you said about kind of opportunities, and perhaps Amy, you as well. Beyond COVID, what technologies, what areas are you looking at as growth areas that you're looking to invest in?
Well, but we've been big fans of all things in the accommodation space. We've been saying for years that, accommodations really is, I think, defined as where people sleep when they're not at home. It's not just defined as, hotels, vacation rentals, and the like. And there's a lot of really interesting stuff happening in the category, specifically in what we've traditionally thought of as the alternative lodging category, this big, poster child of Airbnb going out public. There's still a lot of really interesting stuff happening around that sort of, alternative form factor of accommodations. And so we like that category a lot. We've also been big fans of all things related to the accommodations tech stack. I think that what COVID has shown us, many of the major suppliers in travel were caught flat-footed by COVID, right? And I think there's this sort of renewed attitude of we can never let that happen again. We have to figure out how to drive more agility into our business models and find tools that will enable us to drive more productivity into our cost structures. So there are many sort of aspects of the hospitality tech stack, everything from the property management system that sits at the heart of the business to vertical software solutions and revenue management and other categories that I think are going to see a real renaissance, and there'll be some strong growth stories in the years ahead. And so that's an area of interest for us. And I also, maybe this is a little bit longer term, but still very interested in the digitization of the tours and activities category. It's a massive, $180 billion landscape. It is utterly fragmented and analog, hit really hard by COVID. And now there's sort of this renewed energy as it begins to come back that, if you're playing in that world, you have to have some sort of a digital strategy. You have to understand that distribution of that type of travel product is really different than other types of travel product because of the, in-market purchasing of that product. And there are some really interesting companies that are stitching that space together, and others that are beginning to, have been tackling it at the top of the funnel as well. So it's a category that I like too. And there's a few others.
Thank you. And Amy, just if we can quickly have you.
We also have one of our investment themes is kind of reimagining accommodation. So we do like that space as well. And from our perspective, we're thinking about it from a consumer perspective. So maybe some of the short-term rental type of opportunities, or how does accommodation look that is a little different from the traditional kind of hospitality companies that are out there. But really, I think what's going into 2021, especially the couple areas that we're really excited about are, number one, contactless tech. And I know this is a story that's been around for a really long time, and we shouldn't be thinking of this as new, but in our industry, the aviation world especially, we have not utilized contactless tech as much as we could have. And I think there's an opportunity now where it will actually be really exciting to see how things kind of become more mainstream. We really like personalization. Again, another thing we've been talking about for a really long time, and should have probably figured out that space in the industry a long time ago, but we like personalization as an opportunity for some of the newer startups that are trying to tackle that space. And then sustainability. For us, that's another investment theme that we've been really excited about for a long time. But coming out of the COVID crisis, we think that a lot of companies in the travel space will double down on their sustainability goals. And there's a lot of opportunity for some of the newer tech and sustainability to kind of gain some traction. We also are very excited about urban mobility. And so we've invested in an eVTOL company that is making really great strides in terms of getting certified. And it'll be interesting to see how that plays out, maybe not for 2021, but for the next couple of years. So that's a space we pay attention to as well. So that's kind of the stuff that we're really kind of getting excited about as we come out of finally the COVID crisis and stop, looking at the COVID specific technologies. That is where we've spent all of our time this year.
Thank you.
And I want to switch gears a little bit here. There's a couple of different topics that come up every single year in the conference, and I want to make sure we hit on a couple of those. And one of the big ones is, one year the OTAs are the enemy, another year they're a friend, and some other years we've been talking about them as dinosaurs. What's your thought as we come out of this? Where do we land on the spectrum for the OTAs? Are they dinosaurs, or does this open up somehow new opportunities for them? Mark, let me start with you.
Well, they're going to see it. It's going to be a very painfully slow recovery for them. I was just talking with Glenn Fogel at Booking yesterday. He's looking at years for a recovery, not quarters. And he's also in leisure travel. I think Chris made some good points earlier about how corporate travel, there will be some resiliency there. Of course there will be, especially when you get competitive dynamics involved. But you're going to have leisure travel snap back first. So for those OTAs, Expedia and Booking, they should see a reasonable recovery. But I don't know whether it's 22 or 23 before they're back to 2019 bookings levels and revenue levels. And then what's really changed? Well, I think the rise in alternative accommodations, these companies have reported it. You can see it in the financials that Airbnb disclosed. It's not terribly surprising, but the data is there. Their year-over-year declines are much less severe than what Booking and Expedia had. And then the percentage of bookings that names like Booking and Expedia both had that are alternative accommodations versus traditional lodging accommodations, those have really gapped up. And there's no question that consumers already knew about alternative accommodations. They weren't a secret, but you certainly had much greater usage of alternative accommodations. And I think that means that post-COVID, consumers are going to think about that more, that travel distribution names like Booking and Expedia at the margin probably gain greater leverage versus traditional hotel companies, because leisure is going to be more important to traditional lodging companies, because corporate's still going to be deflated for some time, and because leisure distribution companies can say, well, we can also take these consumers and send them over to alternative accommodations. I just think we've just changed the leverage a little bit in the game. So no, I don't view Booking or Expedia as dinosaurs. I think they'll be able to recover post-COVID and get to kind of low double-digit revenue growth. High margin businesses generate a lot of cash flow and hopefully use that for smart acquisitions and new investment areas. I think there'll be interesting investment vehicles for the next 3 to 5 years.
Yeah, Amy, Chris, thoughts?
Just from my perspective, I mean, Mark, you mentioned this, the traffic that's going to recover, from our side of the business more quickly will be domestic, will be, VFR, leisure traffic. And that tends to be the bread and butter for OTAs from an aviation perspective, from an airline perspective. So certainly that is going to be what recovers first as we see air traffic recover over the next year and a half or so. But then the other side of that is how much is our existing companies going to take this opportunity to move a little bit away from the OTA model and into more direct bookings. It could turn out that way. That's always been a tension within the aviation, the airline space. How much direct booking versus OTA bookings do airlines want? So, it'll be interesting to see how it plays out.
And I think that's where the fragmentation of the accommodation sector makes the dynamic a little bit different, right? And what we've seen in past recovery cycles is that there's a real battle for share and for direct share. And it would seem to me that coming out of this, especially because we are looking at a few years of continued weakness, that for small chains and independents in particular, and even the big chains, and you remember that big chains are just brands that are monetizing somebody's real estate, right? In the end of the day, it comes down to a discrete piece of real estate that needs traffic. And if the OTAs are showing up saying, "I've got business, are you telling me you don't need any?" I mean, I don't think of very many owners who are going to turn away business when they're working their way through 55, 65% occupancies. So, there's an opportunity for the OTAs to gain stronger footholds, to add share to those businesses. So, I'm really interested to watch 2021 and 22, the sort of mix of share between direct and intermediary bookings. It's going to be really interesting, especially in the leisure category for sure.
Yeah, and I guess no panel would be complete if we didn't at least talk about Google a little bit here. Mark, your perspective on regulatory scrutiny, does it derail their efforts in travel? Do you ever see them, kind of pulling back on the squeeze we've seen play out in travel over the last bunch of years?
Okay, so there's no question that regulatory risk has risen across big tech. This is a bipartisan issue now. That wasn't necessarily the case a few years ago. It clearly is. Those congressional hearings that we watched this summer, I thought were fascinating. I mean, that was a bipartisan can of whoop ass that Congress opened up on big tech. Hey, by the way, I thought it was a great thing. We like to see the most powerful, the richest people in the country, have to get on be pressured by our elected representatives. That's a great thing. I do worry about some of the charges that I've seen. I worry about regulation getting a little bit excessive. So far, it's probably been a little too on the light side. I think one thing is clear: large scale acquisitions are completely off the table for your Googles, your Amazons, probably Facebooks, Microsofts, Apples. Those won't be allowed. So I'm not sure that Google ITA acquisition of several years ago, if that would be announced now, whether that would go through. My guess is that it wouldn't. And other than that, yes, this should be a positive thing, I would think, for some of the travel providers. At some level, you're going to have a little less pressure, a little less. The elbows are going to be a little less sharp from the names from companies like Google, because there'll be regulators there watching their every move much more critically than they were 5 years ago, 10 years ago. It's a generational change.
Interesting.
All right, Amy, Chris, Mark, thank you so much for joining us. We don't want to be the people that stand in front of the audience and Mr. Hafner, so we're going to sign off here, and I hope to see everybody next year.
All right, thanks so much.